We dividend investors can't resist a good deal, and right now there are so many different ones to choose from, but in today's video, we'll be honing in on 3 stocks that seem like particularly great pickups for your portfolio as we make our way into May. But real quick, before we get to those, I want to hear from you. Leave me a comment below and let me know which stocks you currently have your eye on. I'd be curious to hear what you think is looking good. So guys, the first one on our list today is going to be Prologis, which is a company I don't think I've ever talked about before here on the channel. And in case you've never heard of it before, Prologis is the global leader in logistics real estate, and their vast portfolio of industrial properties, which includes distribution centers, warehouses, and other types of industrial facilities, makes up a total of 1.2 billion square feet spanning across 19 countries. Some of the company's top tenants are the largest businesses in the world. We're talking the likes of Amazon, FedEx, DHL, UPS, and Home Depot, just to name a few. Now, earlier this month, Prologis released their quarterly earnings where they beat expectations on both the top and bottom line, which is great. But with this, they lowered their FFO guidance for the year as a result of concerns over this higher interest rate environment we're still in, which ultimately, as I'm sure you can imagine, pushed the share price way down. Looking at the share price performance over here on Seeking Alpha, just in the last 30 days, Prologis has seen a crazy drop in share price. They're down over 18%, which might be one of the worst on the stock market. And if we zoom out looking at the performance just so far in 2024, year to date, they're down 21.5%. So once again, another substantial share price drop there. And if we zoom out once more over the last year, overall, they're down 14.6%. So all of their losses in the last year and then some have come just in the last month. And this leaves them not too far off from their 52-week low. Now with this drop in share price, guys, it's going to have the dividend yield sitting considerably above the 4-year average yield by a long shot. Right now, you can buy Prologis and lock in a 3.69% yield, which is pretty decent. So as far as real estate investment trusts go, Prologis' yield is going to be a bit on the lower side, especially compared to some of the other REITs out there like Realty Income, WP Carey, VICI Properties. But I'll tell you what they lack in yield, which still a 3.7% yield is not bad, but what they lack in yield, they more than make up for with the 5-year growth rate. Prologis is going to be one of the highest dividend growth REITs out there with a 12.63% 5-year dividend growth CAGR and a 10-year dividend growth streak, which is not too shabby. So if you're in the market for another real estate investment trust, and if you're looking for another great dividend growth stock, I definitely think Prologis is worth considering. Now, our second stock today is going to be Humana, which is one of the world's leading health insurance and healthcare companies. And as such, they're a major player in the Medicare market, which has actually been the cause for this company's recent share price declines. Earlier this month, the Centers for Medicare and Medicaid Services set a lower than expected reimbursement rate for private healthcare plans for 2025, which essentially means that these managed care companies will receive less money from the government for each Medicare plan member they cover. So that will have a negative impact on the company's revenue, which, as I'm sure you can imagine, will have a negative impact on the share price, at least here in the short term. And as we can see, this news caused a pretty big drop off in Humana's share price. Right there is when they really jumped off a cliff, which leaves them with an overall loss of 6.4%, which leaves them with a year-to-date loss so far that is much greater, about 29%, almost 29%. And if we zoom out once more, looking at the performance over the last year, it's even worse. They are down 35.16%. And like with Prologis, they are not too far off there from their 52-week low. Still though, just like what we saw with Prologis, this sell-off and this substantial drop in share price has just done wonders for the dividend yield. By buying Humana at today's share price, you can lock in a 1.09% dividend yield, which in its own right is not the highest yield at all, but look at that, guys. It's almost 55% above the company's 5-year average yield, so that's quite a big difference there. And with that, the rest of the dividend stats are just looking pristine. The payout ratio couldn't be lower at 13.6%. It's definitely one of the lower payout ratios out there, which is really good to see. And the 5-year growth rate's pretty sweet too, 11.5%, and they've been growing the dividend for the last 7 straight years. Now, the third stock on our list today is going to be Zoetis, which is the world leader in animal health. And we first introduced this stock in last month's video, but since then, the share price has slid even further south, making it a much more attractive buy today. Just in the last 30 days, Zoetis has dropped off another 11.5%, which is just crazy. But this kicked off after the Wall Street Journal reported a slew of side effects linked to a couple of the company's arthritis medications, Librela and Silencia. So apparently the FDA has received more than 12,000 than 300 reports of side effects involving Librela and more than 7,700 for Silencia since 2021, so over the last few years. Now, as I'm sure you can imagine, Zoetis says the medications are safe and says the reported side effects represent less than 1% of the more than 18 million administered shots of both drugs combined, so not a huge amount at all. Still, though, side effects are never a good thing, especially when it comes to the pets that you love so much. People are definitely going to feel a certain way about that, understandably so. So we'll see how all of this plays out, but in my opinion, at least for now, this seems just like a short-term issue that's not going to completely ruin the company, and in the meantime creates a pretty good buying opportunity. Anyway, getting back to the share price performance, overall 2024 has not been kind to Zoetis, and so far year to date they're down 26.25%, so quite a big drop there. And if we look at the performance over the last year, they're down 14.6%, which has them right there at their 52-week low. Now, taking a look at the dividend yield here, like we saw with Humana, the yield's not going to be the highest, a little bit higher than Humana's at 1.19%, but look at the spread between this and the 5-year average yield. It is almost 72% higher than the 5-year average yield of 0.7%. So that is quite a big difference there. You're able to lock in a much nicer cash flow return by buying at today's prices. And as far as the rest of the dividend stats go, these are looking great. The payout ratio is coming in sub 30%. We like to see that. And the 5-year growth rate is off the charts. Almost 23% dividend growth on average over the last 5 years. I love to see that. And they've been growing this thing for the last 5 years. Now, Zoetis is actually one that I'm considering adding to my own portfolio. I think there's a lot to like about this company. And I think the best case scenario is playing out right now for those who are interested in swooping up some more shares. With that said, I think the same is true for all 3 of these companies. I think they're all great ones to consider, but they're not the only ones. There are still so many other companies out there that I think you need to keep your eye on. The first of which is going to be Apple. In the last 30 days, they're down 2%, which isn't anything too crazy, but if we zoom out looking at the year-to-date performance, Apple's down a lot more. They're down 14.2%. Next up, I think Agree Realty is another one to keep an eye on. As opposed to Apple, they're actually up 2% in the last month. But if we look at their year-to-date performance, they're down 9, actually now that it updated, 8.6%. And if we look at the performance in the last year, they're down a whopping 14.7%. So definitely keep an eye on this one. Moving on, the third stock you definitely want to keep an eye on is AMT, American Tower Corporation, especially after this 10% drop they've seen in the last 30 days, which leaves them with a loss so far in 2024 of almost 19%. And zooming out once more over the last year, AMT is down 15.5%. Next up, keep your eye on APD, Air Products and Chemicals, who's about flat in the last 30 days. They're only down 0.4%, but looking at the year-to-date performance, it's much more. They're down 14.4%, and over the last year, they're down 20.1%. So a pretty big drop there. Next up, keep an eye on AWR, American States Water Company, which is a dividend king in the utility sector. They're down about 1% in the last month, which leaves them with a year-to-date loss of 12.2%, so a decent drop there. And over the last year, they're down about double that. They're down 23.6%. Moving on, guys, keep your eye on CVS. They're also seeing a very substantial drop in the last month, down 12.6% almost, which leaves them with a year-to-date loss of 11.6% and down not as much in the last year, but still in the red by 7%. Next up, guys, Dolby Laboratories, I think, is looking pretty good too. This is a really solid company, and they're down 4.5% in the last month, which leaves them with a year-to-date loss about 8.5% and a loss in the last year of 5.25%. So all across the board, they're seeing red. This could be a good opportunity to swoop up a really solid company at a pretty decent price. And speaking of solid companies at decent prices, guys, keep your eye on the Hershey Company, who's down again in the last month. They're down 4.8%, but they're still in the green, actually just barely so far in 2024. They're basically flat, hardly up at all. And in the last year, they've seen a pretty big decline. They're down 28.25%. Next up, guys, you've got to keep your eye on this dividend king, Johnson & Johnson. I certainly am. I've actually been adding a bit more Johnson & Johnson in my own portfolio. But looking at the share price performance, in the last month, they're down about 3.5%, which leaves them with a year-to-date loss about 4%. So not too bad. But over the last year, they're down about 9%. So I definitely like this opportunity to buy J&J on the dip. Definitely take advantage of that. Next up, guys, definitely keep your eye on Nike. We actually talked about this one in last month's video, and since then, they've seen a little bit of a gain. They're up 1%, but still year-to-date, they are down quite a bit. They're down 13%, which leaves them with a much bigger loss in the last year, about double that amount, down 25.9%. Moving on, guys, you got to keep your eye on the monthly dividend company, Realty Income. I thought for sure we were going to see it get below $50 per share and continue to go even lower, but it started its ascent, and in the last month, it's up 2%, but Year-to-date realty income is still down 7.4%, and over the last year, they're still down 14%. So I still think now's a pretty good time to buy. Moving on, next up, guys, we've got Starbucks sitting sub $90 per share. I love to see that, and I've actually been adding some more of this one to my own portfolio as well. I bought some Starbucks this week. I bought some Starbucks last week. I'll probably buy some more Starbucks next week. But anyway, in the last month, Starbucks is down 3%, which leaves them with a year-to-date loss of 8.3% and a loss in the last year of 19.3%. And then, guys, next up is Snap-on, which I haven't talked about for a while. It's been a while since we've seen any meaningful declines from Snap-on, but in the last month, they're down 6.7%, which leaves them with a year-to-date loss of 5.8%. But they're still up in the green by about 3.8% in the last year. So we'll see what Snap-on does from here. I'd love to see it come down even more, and if it does, I will certainly be swooping up some more shares. And now jumping back over to the real estate sector, guys, Vici Properties, who's down almost 2% in the last month, which leaves them with a pretty substantial year-to-date decline of 12% and a drop in the last year of almost 14.5%. So all across the board, we're seeing red for Vici, seeing it sitting sub $30 per share. So I think that's a pretty good place to buy. And with that, those are all of the stocks that I think are good ones to watch right now. And in this next video right over here, I'm telling you about 3 more stocks that are actually the exact opposite. These stocks are trouble, and you would definitely regret buying them. So click right over here to find out which ones they are, and I'll see you in the next one.